Welcome to Revere Asset Management's Your Money with Danny Stewart
The market will always overshoot to the downside and to the upside.
and Don Vandenbord.
Because it's not how much you make in the markets, it's how much of that you can keep. It's not how much you make in the markets, it's how much you can keep. You got the pinch hit host this week. Dan's on a road trip with his wife. We are going to wing this without our glorious leader. His large brain will clearly leave a void in our content, but you're stuck with the technical team today. And we've been busy this week doing what we do at Revere, protecting the downside when you're in a bear market. We're going to start right off with a chart here. The S&P 500. Now, some people will be arguing that's technically not a bear market because we haven't closed 20% below the high print from mid-February, but multi-times intraday, we've gone below 20%. Small caps are in a bear market. NASDAQ hit bear market. Leaders have been decimated. If this isn't a bear market, I don't know what a bear market is, but what we're looking at, we're going to go right into the technical charts. But first, I want to mention what we've been busy doing, and that's signing up new clients. We've been putting out a lot of content on Twitter, on our videos, and word of mouth from our current clients is spreading to their friends and family. And I want to send a note out to advisors out there. Dan and I have discussed this. If you've been suffering under pie chart-itis, give us a call. If you want to bring your book of business over to Revere, we would be more than happy to have it. Introduce our technical analysis and our process for preserving the downside and participating in the upside. When the markets work, we're participating. When they're not, we're getting the heck out of the way. And it's the bear markets that are an absolute killer of your nest egg and need to be avoided, especially if you're approaching retirement. Also, if you're flying solo, we can talk to you about licensing our protection approach. And basically, we want everybody that hears or learns about us to know that you don't have to be at the mercy of the market when it's going down. This is a brutal sell-off. There's massive economic consequences or fallout from what's going on with tariffs, and the fallout is not clear. The market hates uncertainty. Multiple companies have come out and that have reported earnings, and they're unable to give forward guidance because they don't really know how the implications of what's going on is going to impact their business. When you don't know what their forward guidance is, you can't determine what the returns are going to be or the target earnings per share for the S&P 500. Analysts project for the forward year what the earnings are for the S&P 500. And the market, depending on whether it's confident or not, assigns a multiple to those earnings. And that's what results in either their targets for the S&P 500 or what the S&P 500 is actually trading at. A lot of institutions follow this. They don't do what we do watching technical analysis. They're more on the accounting side, more on the earnings per share side. But what they're doing certainly impacts what's going on in the overall market. From our perspective, we don't really care what the forward earnings is, what the multiple is. We're going strictly by the charts when we're preserving capital or making investments into the market to try to grow that capital. And we've been getting a lot of calls. The best calls that we get are when Dan signs up new clients and they decide at first they don't want to bring all their assets over. And he tells them without fail, that's fine. Within 6 months or a year, we'll get the rest of them anyway. And we've got at least 5 clients that have reached out and told us that, yep, you were right. I'm bringing the rest of my money over because where I left it did absolutely nothing to get out of the way. I talked to them. All they said is, well, we might be near a bottom, got to think long term, and basically they stay allocated. And that's a mistake. That's a dream crusher. That's a financial health crusher, not at Revere. So what we're looking at, let's go to the chart, a chart of the S&P 500. We initially started to get more defensive all the way back here in mid-February with the break of the 21-day moving average. That's what we use for our short-term trend indicator. Then we broke the 50-day moving average and couldn't get back above it for a solid week. We took off more exposure there. Then we undercut and reclaimed the 200-day moving average in early March. That was kind of a line in the sand. You wanted that to hold. And from research that we've recently done, we used to pretty much get out of the way below the 200-day moving average, but studying visits to the 200-day and below that don't result in a full bear market, there's about a 3 to 4% window in here where you can allow the market to chop around without completely pulling the plug. But at this point, below the 200-day, we're down to about 20% exposure just in the S&P 500 and all out of individual names. We had a little bit of a rally. Third week in March, got back above the 21-day moving average and the 200-day moving average, but only for 2 days. And then we broke back below again. We put some exposure on that Monday when we got above. We took that exposure off on Wednesday when that move failed. We came down, tested this 5,500 level again, which was right where the prior pullback stopped. And at that point, everything's fine again. The market gave you 3 days of a bounce right into the declining 21-day moving average, again, our short-term trend indicator. And after the market closed on this third day up is when Trump came out with his chart in the Rose Garden, discussing what the tariffs were going to be, and all bets were off after that. Big gap down, close at the lows, another gap down the next day, an attempt to put in a bottom the day after that. Same thing with the following day. And then on Wednesday of this week, Trump delayed the tariffs for 90 days on everybody but China. And look, we rallied 10% that day, but where did we stop? The declining 21-day moving average. Bulls, was it a short? Or the question that we ask, we don't predict, is it just a short squeeze or is this a bottom? And we can at least start finalizing our watch list for possible entries. And yesterday said not so fast, with a gap down, did finish off the lows. And now today we're just bouncing around in about a 2% range, going from up to down. Right now, as of 11:50 Eastern time, we're at about 5270 on the S&P 500. So you can see things are tightening up a little bit, and you want them to tighten up before we move in one direction. However, when you form contraction patterns like this, they normally resolve in the direction of the primary trend, and it's very clear that the primary trend right now is lower. So that's what we're focusing on. The only thing that we have exposure on for clients that didn't move in legacy positions that we have hedged are some tactical moves with exposure to the S&P 500 at different support levels and resistance levels. In a market like this, the best move to do, and this is difficult to do, you want to think, we lean long. We want to be long. We want to have be making money for our clients on the long side. So when you get up near the 21-day moving average, there's two scenarios. One, do you break back above it and attempt to put in a bottom and attempt to rally? Or in a downtrend, if you're going to stay in the direction of the primary trend, like I mentioned, should you be looking to short or take exposure off at that level because you're going to fail and go lower? That's what happened 2 weeks ago. That's what happened on Wednesday of this week. It's also what happened 3 weeks ago with two closes above the 21. This declining short-term green line, 21-day moving average, we pay a lot of attention to it. But yesterday in the short term, we were paying attention to 3 levels. And they're ultra short-term levels, just to see if the market can attempt, if the bulls can put up a fight and stop going down. So the first one is a 50% level of that big Upday on Wednesday. The shortest term we track is the 5-day simple moving average. And then what we talk about a lot is the 8-day exponential moving average. And right now we're trapped between that halfway of that big candle. That is providing some support. We undercut it yesterday, but reclaimed it. It's providing some support. The 5-day moving average is not shown on here, but that's also providing some support. But on the upside, the 8-day exponential moving average is providing resistance. So we're either going to break back below the 5 simple, which on the S&P 500 is around 5203. So we're keeping our eye on that 5200-ish level. On the upside, the 8-day moving average, which has now rolled over because of the pullback after the big up day on Wednesday, the 8-day moving average is about 5303, and the 50% line on the S&P is 5214. And that's where we're bouncing around that short-term area right there. Which way we break on that will determine the direction that we are at least considering putting on or taking off exposure. And then when we run into that declining 21-day moving average, that's where the rubber will meet the road in the next big resistance area. That's our short-term moving average that we use. The 5 and the 8 are ultra short-term. And then you've got the 50-day moving average doing a death cross now, breaking below the 200-day moving average. And Todd's going to talk a lot about that on his presentation this week. So that's what we're looking at on the indexes, and I'm going to turn it over to the fellas. At the end, I'm going to talk about some double bottom bases. I touched on this a little bit in Thursday night's video. Some decent fundamental names are setting up in double bottoms, and you can kind of see this ugly double bottom that the market is setting up in. First leg down, the bounce up here to that 200-day moving average, the huge drop after the tariff announcement, and now working our way back up. The pivot point for the double bottom is around that 57.87 level, right around the 200-day moving average. Also notice the slope of the 200-day moving average is rolled over. That's when the worst bear markets occur, is below the declining slope of the 200-day moving average. So from this ugly double bottom base, what's going to happen? Are we going to rally up and fail? Or are we going to get a follow-through day, an O'Neill follow-through day, with some decent setups and break above the double bottom base that we're talking about? The midpoint of the double bottom bases on not only on the index but on the various stocks that are setting up. These best stocks did not drop nearly as far relative to the midpoint that the S&P 500 did. If Dan was here, he'd put his Don interpreter on, but he's not here, so you're stuck with what I just explained. And if you have any questions when we post this to YouTube, feel free to put them in the comments. We always address the comments in YouTube. So that's where we are. I'm going to turn it over to the fellas now. We're going to start with Ted. He's going to talk about what's been causing a lot of this volatility, and what we're seeing is the goal of the administration was wanting to get longer-term rates down, but the market is fighting that. And as rates go higher, the market has been going lower pretty much in lockstep. So take it away, Ted. I'm going to bring up a chart of the 10-year yield, and Ted will discuss this.
Yeah, so thank you, Don. Over the past few months, you've probably heard or read and seen more about the bond market and the 10-year yield than really, at least in a couple of years or a few years. But before I get into my segment, demystify just the situation with the 10-year, the fiscal debt with our government, and the policy from the administration, I think it's important to carry on from Don's point of the pie charters. When they stay fully allocated, they might tell you that bonds are the safe investment when markets go down, but as you can see, the 10-year is spiking. And Don, if you could bring up a chart of the TLT, that has sold off along with stocks. So your portfolio, even if it's 60-40, all assets and securities in there are actually headed lower. There isn't that that previous thought or that previous thought where as stocks drop, bonds rally as a defensive mechanism in your portfolio. And right now we're seeing not only risk off, but risk out. And people are flying out of US assets in general. That's why we're seeing gold shoot higher. We're seeing the dollar drop. We're seeing bonds drop. We're seeing stocks drop. And really, we haven't seen this action in a very, very long time. And it's definitely concerning. So back up a few months, that was confirmed late January, and shortly after, the 10-year spiked to nearly 5%. And kind of just a simplified explanation of why the 10-year is so important. And one of the most consequential numbers that every investor and trader looks at is because the 10-year dictates mortgage rates, the 10-year dictates the cost of borrowing in the economy, and that is really important for companies to take on debt, whether that's low interest debt or high interest debt, and invest in buildings, machinery, or other activities that businesses conduct, or even just hiring people. So higher rates always will cause pressure on the overall economy. And Besant's goal, he stated multiple times, along with the Trump administration, is to find a way to bring it down. On top of this, we also have 6 to 7 trillion of our debt maturing this year that came from the previous administration because they issued so much debt on the short end of the curve, meaning that they issued a lot of debt, and that debt is expiring much fast. Like, they issued a lot of debt on the short end means maturity on that debt is much faster, and that debt is coming due now instead of issuing on the long end where you can push off the day where you have to repay that debt. And so one thought potentially, or one narrative of the tariffs, not only of Trump's goal to onshore manufacturing or rejigger all of world trade, was to potentially cause a little bit of chaos in the market, some short-term pain, and hope that people fly into the bonds for a safety trade, pushing yields down. And initially that worked really well. You can see from that almost 5% level, 4.8%, it dropped all the way down to about 3.8%. And the figure equates to about 1 basis point is about $1 billion saved for the federal government. And the problem is, after he announced those huge reciprocal tariffs and then announced higher tariffs on China, China started retaliating, and that kind of just put in a huge reversal there. And this leaves me to this point. There's many narratives floating around, and I'm just here to present it to you. I'm not here to argue or debate which one's right or wrong. It's just the various narratives and stories being told right now about why the 10-year is heading higher. And really, this is quite a violent move in the bond market. And when bonds are moving like this, this is trillions of dollars moving around. So the first one is, since we're in this huge trade war with China, I believe we're at 145% tariffs on them, and they actually increased tariffs on us, equating to about, I think, 125% now. Some believe that China and foreign countries are selling our bonds to engage not only in a trade war, but a capital war. And I mean, to kind of confirm this narrative, Trump has floated the idea of delisting Chinese equities now too from our exchanges. So there's a two-fronted war now going on with China. Hopefully it doesn't turn into some hot war, for example, like China invading Taiwan. The second narrative, bonds are potentially front-running a Fed rate cut, or multiple Fed rate cuts, or just more Fed rate cuts than expected. What we've seen is the short end of the curve has been falling, but now it's even rising with the long end. The 2-year hit lows of like 3.87%. That makes sense because the Fed controls the short end of the curve. And if they do cut rates, that's stimulatory, and that could be why the 10 and 30-year are heading higher. Third, I believe we got the half year of fiscal 2025 budget numbers. And if this continues, we're on a run rate for 2.6 trillion in deficits for fiscal year 2025, which is even more than previously. And that equates to 9% of GDP, which is unseen during peacetime, which means during non-war or non-recessionary times. And this could also be scaring bond investors. Why own US bonds if the default risk is higher, if the risk of the US government being unable to fulfill their obligations to pay back their debt and interest payments? That could be a reason why there's a flight out of bonds as well. Fourth one, tariff is just plainly going to cause inflation. And if there's inflation, that pushes the 10-year yields higher. And that just aligns with traditional economic theory. And then the fifth, I've seen some narratives starting to talk about how potentially over-leveraged banks, funds, or institutions are deleveraging their bond positions right now, especially just with the deficit, and a lot of uncertainty regarding the U.S. government and the administration's policies. And really, just to sum it all up, there's just some of the narratives floating around. We'll see how this plays out, but bottom line is it's not a good situation to be in. The goal, at least one of the goals of the administration, to get the 10-year yield down is failing right now, which means we might have to potentially refinance our debt, which is about 6 to 7 trillion at a much higher rate. And that really just decreases the flexibility and mobility of our federal government, especially with our current budget deficit. Because if you think about it, our current interest rates are about, interest payments is about 1.25 trillion, and that's nearly half the deficit. So we're going to get to a point where a fifth or a fourth of our revenues from the government yearly is just going to pay down interest payments on the debt. And that's definitely not a good situation for our government to be in if we continue down this road. And who knows exactly what will happen, but it's just not a good place for our government, and things definitely have to change. But not here to debate what exactly needs to happen, what's right or wrong, just demystifying the situation, because there's a lot of things going on. You probably feel a little overwhelmed by all the moving pieces, and this is really just a breakdown of the last few months and some narratives.
Good stuff, Ted. One of the I've got 3 arrows drawn on here, and one of the interesting things about this move in bonds over the last 2 weeks is the saying that we repeat on here multiple times: from failed moves come fast moves in the opposite directions. And it's one of the reasons why, regardless of what you're trading, whether it's bonds or stocks, if you've got a breakout setup that happens and then fails, you got to cut that loose very quickly. You can see 2 weeks ago we broke above, this is the 10-year yield, we broke above the range that we've been in, but it failed quickly, right back into the base and then down to the lows. This is the second arrow that I have here. So again, a failed move higher resulted in a fast move lower, and we broke below the bottom of the range. So again, a breakout to the downside, and then that failed. The breakout to the downside resulted in an even quicker move back to the upside. So from failed moves come fast moves. You saw it twice, once in each direction over the past 2 weeks. And this volatility in the bond market is not good in any way, shape, or form, building confidence in the markets. And the bond market is much larger than the overall equity markets are worldwide. So that's another reason why it's the largest concern, not to mention the 37 trillion in U.S. bonds that are out there. Thanks, Ted. Next up, we're going to go to Connor, and Connor puts out, if you're not following Connor on Twitter or X, you're really missing out. Ted and Connor put a massive amount of content out there, and Market Watch picked up some of Connor's quotes this week and featured him in an article that they were writing, and we're going to discuss that a little bit at the end. But first, we're going to show a few charts, and Connor's going to take you through them. So take it away, Connor.
Yep. Yeah, so on Tuesday, I did a big thread on Twitter just of a bunch of breadth charts that I follow and kind of what my thoughts were. And coincidentally, Wednesday morning when I woke up, I saw that someone was like, hey, you were featured in a Market Watch article. Had no idea, but the writer took some of the work and posted it on there and quoted me a couple times. So that was pretty cool to see, given, you know, we spend a lot of time posting on Twitter, market thoughts, and it was cool to see that on one of the biggest financial media outlets in the world. So what I wanted to talk about was some of the things that I talked about in that thread. And so these are breadth charts from Tuesday because I wanted to show what I was seeing in the market at the time. So the first one is the percent of stocks above the 5-day moving average. And this is my favorite short-term breadth indicator. I like to call it the fear FOMO indicator. And basically after the close on Tuesday, this hit 5-year lows. This closed under 1. And if you go back since inception of this, percent of stocks above the 5-day, anytime it gets below 1, there's a very high probability that the market is going to bounce. The rubber band can only stretch so far one way before it snaps back. And you can use this two ways, right? If I see this is definitely not the time to be going short, not necessarily the time to be going long, but it also just gives you a better picture of, hey, we're pretty extended to the downside, all these in stocks even more than the indexes. And when I see this at 1, my expectation is that the market very much likely sees a bounce soon. So that was the first thing. And that was the lowest reading really in years. I've never seen it that low. And some of the other ones, like don't have the charts up, but S&P information tech stocks above the 5-day moving average, that was at like 0.01. So, not much room lower there. And then more of a medium term, the next chart is just a chart of the S&P 500 overlaid with the percent of stocks above the 20, 50, and 200-day moving average. Wait until Don gets that one back up. Yeah, here we go. And so I have the chart of the S&P 500. So, right, 5-day moving average, that's a very short-term moving average. So you can lengthen the horizon a little bit by looking at other things. And you can see this is the 20, 50, and 200-day moving average. Stock charts doesn't have the 21 EMA. So, this is basically what we look at on our trend gauge, right? And you can see the percent of stocks above the 20-day moving average, that was only 6%. That's one of the lowest readings in many years. Again, showing the destruction that occurred in the market and how oversold stocks were. And then there was only, 2% of stocks were above the 20-day, and then only 6% of S&P 500 stocks were above the 50-day moving average. Again, just historically extremely oversold. And then lastly, the 200-day moving average, only 18% of stocks were above the 200-day moving average. And if you use the 200-day as your gauge for a bull bear market, that means 82% of the S&P 500 was in a bear market. And typically, historically, when you get down to those levels, a rebound is very likely. These were just all giving a very, very similar signal in terms of that, there wasn't too much room left lower for the market. And as long as Monday's lows held, there was a high likelihood that maybe the market works off some of these oversold conditions. And then the next one is net new lows. This is another one that I like to look at. And as you can see, net new lows, basically worst reading since 2020. So again, most of the stocks in the market were making net new lows. And again, that's not just a reason that the market's going to reverse. That's bearish, stocks making new lows. But when you see all these things line up, very oversold, new lows look like they washed out, that's another indicator as well. And on the flip side, it can work for the upside too. When you get these huge new high readings, like extremely overbought, that could mean the market might pull back. So kind of taking a contrarian view on this. And you can see during the whole bull market, they were just steadily climbing up, a couple blips, normal pullbacks in an uptrend. And clearly these readings are full bear market readings. And then the last one is the NASI. One of my favorite breadth indicators, just for when that's hooking up above the 10 EMA, that typically is a good time to be long stocks. And then when it's going down, typically you're going to have a lot more frustration. Buying strength is going to be a lot more difficult. And this one was basically approaching the November 2023 pullback lows. Again, extremely oversold. And then we pair that with the RSI up top, and whenever that dips down to sub 20, sub 10, be on the lookout for a reversal. I'll say it again, the rubber band can only stretch so far. But given we're in a very highly news-driven market, a lot of macro going on, obviously some of these breadth charts isn't going to override the macro, a huge headline from Trump or the Fed, but this can give you a really good gauge of where we're at in the market cycle. And then Don, if you just pull up a weekly chart, the S&P 500. And last thing I want to say is that never look at breadth in a vacuum. You need to look at it with multiple things. So you can see here, I stacked the evidence using many different breadth charts, and in the article in the Twitter thread, there's more, but I thought these were the most notable. But then you take it a step further and you want to stack other things. So the VIX hit 60, that's pretty overbought. Market tends to find bottoms in that area. And then on the S&P 500 chart, we bounced right off 2021 highs. You can probably, and August 5th lows. So, there's a combination. You have your breadth chart super oversold. You have a key level on the S&P 500. Sentiment-wise, people are really scared. VIX hit 60. So when you put all those things together, that can help give a better read on the market. And breadth is something that I find tremendous value in my process. It is something that will never go away. Some people aren't think it's noise, but in my view, if you learn how to use it properly, there's a huge edge in tracking it religiously and helping, especially in a choppy, volatile market. This is when breadth can help staying on the right side of the market when there's so much volatility versus when you're in a clean up trend, breadth can stay overbought and vice versa in a downtrend. And then lastly, you can just show some of those clips or pictures from the Market Watch article and some other things that I didn't cover. I talked about, they quoted me in the article about how I was talking about the put to call ratio. That's another sentiment indicator. And I mentioned it's still a highly volatile market, but at this point, I believe the pain trade is to the upside. And then to recap it, I just kind of talked about how Monday's lows are critical line in the sand. These levels are convincingly broken. The probabilities for a bounce decrease significantly. And that's actually one last point I want to make is in this type of market, you have to go into the trading day open-minded with a bull and bear case because, just anything can change on a dime in this market. So having a bullish scenario and a bearish scenario can help a lot. And that's my segment on breadth. And it was pretty cool to be mentioned in that Market Watch article.
Absolutely. And those charts that you showed being on Tuesday, when you get the slightest bit of good news, when you're stretched to the downside, in this case, it was the change taking the tariffs off of non-China countries, that certainly explains at least partially some of the power in the move up that we saw on Wednesday. Now, does that power continue? It certainly hasn't over the last 2 days, but with a strong day up like that, it's not surprising to see 2 inside days after that. The question is, where will this contraction that we're in over the past 2 days, which way will it resolve? Great stuff, Connor. And now we're going to take it over to Todd. He's got some great stats on death crosses. That's the 50-day breaking below the 200-day on the S&P 500, such as is happening right about now. We're going to step back a couple times in history, and Todd's going to discuss what happened after those prior death crosses occurred.
Yep, we're going to get a death cross on the S&P 500 tonight. We got the death cross on the 9th for the NASDAQ, but in this particular analysis, I just went through all the death crosses that occurred from 2000 on. They're in this particular sample, just going back in market surge and on a year-by-year basis, I pinpointed all these particular dates, and there were a total of 11. And in the far left column, those were the dates that the actual death cross occurred. And the dates that are highlighted in the blue were bear markets, official bear markets where we closed down 20% from the high. in 2018, we went down 20%, but we didn't close there, so that wasn't counted as a bear market. But in the next column, I highlighted exactly where the close was on that given day, and then I analyzed it on two different time frames. If the S&P 500 went on to make a low after the cross within the next 2 months, I would put down the low number for the short term. That's the S&P 500 low column. If it had a NA in there, it didn't make a low within that 2-month period. And then the next column was the date of the low, and then the first baby blue highlighted column are the stats of what the drawdown was from the time of the cross to the absolute low on that short-term basis. And then I did the same thing with the long term, anything longer than 2 months out. What were the long-term gains from the date of the death cross? And analyzing this data, what I found out is that there were only 3 of 11 instances where we went on past the death cross beyond a couple months to make lower lows, and that was in 3 of the 4 bear markets. So on a longer term basis, the death cross in this particular time frame was rare to go on to make long-term losses. But you can see they were all done in 3 of the 4 bear markets, excluding COVID, which happened in 2020. That was only 33 days, so it was very small. But on a shorter term basis, it had better predictive value, as there were 7 of 11 instances where we did go on to make some type of short-term low afterwards. So what I wanted to do is kind of go into 5 periods in this sample to show what happened. And in the first sample, we're going to go to 12/31 of 2001 to look at the internet bubble and see what happened. And on the far left, you can see, I guess on your charts, Don, we got to go back a little further. My time frame, but at the end of the day, we can get the picture. So we started breaking through that. Okay, very good. The first date was 10/30 of 2000. And on this particular case, we went on to make a short-term low about 2 months later for a total of a 10.34% drop. However, on this particular death cross, this bear market lasted 31 months. So it was almost 3 years in duration. So this was the longest, the dot-com bubble was the longest bear market we've had since 2000 by far. And I'm going to put another date on here because we never had the golden cross occur until much later. And Don, if you would go to 10/10 of 2002, we ultimately bottomed out on October 10th of 2002 at 768.67 on the S&P. So that was a total long-term gain of 45% to the ultimate low. And then, of course, it took several months beyond that to get a golden cross, but those were the ultimate lows, and that duration was the longest in this particular sample. If we go to the next bear market, which I'm going to give Don a date of March 6th of 2009. This was the second longest bear market since 2000 of 17 months. And again, a lot of people argue that from 2000 to the financial crisis lows, that was just the lost decade. And that was just one big bear market pretty much, but we had some pretty big rallies along the way. And again, your charts are a little bit shorter in nature than mine, but that death cross occurred on 12/21 of 2007. And we had a 14.4% gain in the short term on this particular one. That bottomed out at around 1270 on 1/23 of 08. And then ultimately we hit the final bottom on March 6th of 2009. And that was a total of a 55.8% drop. So during that time frame, we had a very long period of, and both successful on the short and the long term. Incidentally, those two bear markets were the only two that resulted in positive outcomes for both the short term and the long term on the death cross. And those were the most severe bear markets, naturally. Otherwise, we really either had no short term or long term success on this death cross, or we had short term but not long term. Okay, I know that's confusing, but in general, these were the only two periods where we had both long and short term success on this indicator. And just to wrap up with a couple more dates in the more recent times, if we go to 3/30 of 2019, again, this was not an official bear market, although we did drop 20% from, the September highs to the December lows here, or January lows. This resulted in about a 10.8% gain from the date of the death cross to the lows, and it was a fast and furious situation. But we bottomed quickly, and we went on to have a golden cross in the spring, and we never had a long-term success on that particular indicator. So, and let's do just two more. Let's go to the COVID one just for the fun of it. 6/30 of 2020. Yeah, so we had this death cross occur on 4/1 of 2020. And you can see in this particular situation, this was a 33.9% drop. But the death cross didn't occur until well after the bottom. So there was no success in either. Well, actually there was no success in either one of these particular instances. Maybe like 3%, but you would have been down to get that 3%. Yeah, it was like days, literally a 3% increase on the short term. Again, this was a very fast and furious. And finally, let's go to the 3/20 of 2023. And this was the inflation Fed tightening cycle that caused the bear market. And here you have the death cross on 3/14 of 22. And, in this particular case, we went down a total of 16% in the long term. But from the actual date of the death cross, we were heading back up. So I didn't qualify this as having short-term success because we rallied up back above the 200-day moving average before we ultimately went down to make the new lows in October of 22. So as you can see in this particular indicator, in summary, it takes a long time for a death cross to occur. And usually the sell-off is well underway by the time it happens. So oftentimes you're already making short-term lows potentially and heading back up and potentially already bottoming. And in summary, it was only the severe bear markets where the long-term success of this particular indicator resulted in future and further gains. So it really does not have a significant amount of predictive value. I believe the Revere system is far ahead of when this particular indicator occurs. And And Don, I don't know if you have any insight after looking at these situations, but I just wanted to really see if this indicator that you're going to hear a lot about, occurring this weekend, if you should be really afraid of it. And in our particular situation where we're at now, this sell-off has been fast and furious through this time. So I would imagine that this particular situation will result in more of a choppier, maybe a short-term winner here. But unless we go into an ultimate bear market or a severe bear market, this indicator will not prove to have much predictive value. And that's all I have with this.
Yeah, I think you showed 3 different scenarios with this. You showed one where the cross didn't happen until well after the low. That was with COVID. One where it happened while we were already recovering and getting back above the 200-day moving average. Those are really the exceptions. I think the norm is what you're seeing here, where you're already into the decline. The question is what happens after this decline happens, and a lot of that has to do with really already how far you are stretched to the downside when that hits. Obviously, the other bad thing is that, whether you're above or below the 200-day moving average, the further this 50-day moves and the slope of the line goes lower, that just provides additional resistance back to the upside when prices bounce and meet up with that level. Great study there, Todd. It's kind of ironic. The success of the indicator actually means failure in the market. So that's something important to recall while that discussion was taking place. So I'm going to wrap it with some of these double bottom bases that we've been looking at. These are in stocks that have strong fundamentals, were prior leaders, so they're pretty much well known. But what you're seeing is, along with that double bottom, that ugly double bottom that we showed in the indexes, the stocks are moving very similar and setting up an obvious pivot. Some of them show here, some of them do not. In this case, for Uber, it doesn't, because the prior high was all the way back in October. But on the intermediate term, that setup is there. So Uber. Next up is Palantir. This is one of these. As soon as the market starts to go up at all, you see Palantir really accelerate to the upside. This is the very prototypical basketball underwater, where the market is holding the stock back, and you can see where we've got alert level set for it crossing above the 50-day moving average. And then similarly, it's pulling back to the 21-day moving average right now. If it breaks back below that level, we want to know that as well. But a very strong bounce up on Palantir, and has given back really not much relative to the way that the index is gap lower over the last couple of days. So this one's in our top 5. CyberArk Security, also another double bottom there, also holding up very well since its move higher, along with the indexes on Wednesday. Netflix, this here pattern rec does pick it up, again, holding near the top of that range since the move up on Wednesday. DoorDash, another one, ran into the declining 50-day moving average and back below the 21-day moving average, so not holding up as well over the last couple of days. Spotify certainly holding up right near the highs of the past of Wednesday. Robinhood, this one's very volatile. This benefits when Bitcoin is going up, and Bitcoin's having a good day today. Above the 21-day moving average. Very clear pattern there. CrowdStrike, another cybersecurity, holding up above the 21, ran into the declining 50-day moving average on its recovery, barely undercut the prior low back in March when it pulled back relative to where the indexes pulled back, certainly showing relative strength there. And something common that you'll see on all these names that we're talking about is increased relative strength. Doximity, this will be the last one, and this is one that really hasn't bounced over the setup is there, but it's really not showing any relative strength. So you make a list, and then you start crossing names off if they don't participate in what you're looking for. Of those 9 that I just showed, Doc's the weakest of the 9. That's pretty much gonna wrap it. And I'll bring in my Dan voice so that everybody feels somewhat comfortable taking us home today. All right, if you like what you heard, tell your friends, tell your family. Come on over to revereasset.com and meet us next week on your money. It's not their money, it's your money. Not how much you make in the market, not how much